This graph shows the 18-year property cycle. It shows how property prices changes over the years and the phases it goes through. If you're looking or thinking about buying your first home, you may find this video helpful in understanding the property cycle. The 18-year property cycle is a powerful concept to know and understand, and this information on screen shows the latest house price data. Understanding the graphs can give us a better understanding of how and why prices go up and down. The 18-year cycle graph was made by Fred Harrison, who analyzed trends and market data to come up with this, which is based off 200 years of data. He found that the property cycle follows this similar pattern, and 18-year cycle, and this is something we can compare to now as we currently go through this. Looking at the various data and the market in general, it does seem as if we have passed the peak in property prices and things have started to come down as a result of lower demand. Data from the Bank of England shows that we're going through a property crash as prices slowly go downwards. Now if we go back to the 18-year property cycle and look through each stage, we can see the first part of the graph, which is the recovery phase. Prices have dropped due to a recent market crash at the start of this period. So for this cycle, that was 2008 after a crash. The housing market is in a recovery type phase for approximately 7 years. House prices have dropped and it's a great opportunity to enter the market and buy a home. We then see a mid-cycle dip after a period of growth. This would have been around 2015. It then goes to the explosive phase where the property prices become increasingly more expensive, and this is reflective of 2015 to 2022. The graph shows around 7 years passed during this phase of explosive growth, and you'll see capital appreciation on the property. The peak of the explosive phase is the last few years of the explosive growth, and this can be considered to be the worst time to buy a property. The market is strongest during this time, and investors entering this market would instantly see a decline in value, and it would take them a long time to recover, hence they would get negative equity. Those who purchase at the peak are the ones who suffer during a fall. The subsequent stages last roughly 4 years. The real estate market is currently experiencing a crash and rebound, and interest rates rise. At this point the mood is negative due to the rising interest rates and other factors. Looking at the currently available data, you can see that these stages don't persist indefinitely. Prices of properties fall drastically. We then start to notice the first signs of recovery after a year or two of declining prices. Now the whole idea of the cycle remains true, even if it doesn't follow it exactly. It does reflect the whole trend, and as of right now it seems we're on the crash part of the cycle. Now that we have an idea, we can use the graph to look at a few different scenarios, some immediate and future issues, and what this may mean if you're someone looking to get your first property. People who bought houses a few months ago are now at risk of negative equity as the prices of houses fall. Buying at the peak of the graph means that prices will fall almost straight away, and it means you don't have much equity to play with. It's known as the winner's curse because people have so much confidence in the current market and prices that they get caught up in the hype without seeing the long-term situation. Whenever there is a boom, there's always a crash. It's a trend that's played out throughout history. Now it creates the question as to whether you should buy a house now or wait to see what happens if negative equity is a threat. Should you wait to try and get a house at the bottom of the phase and maximize your position financially? An article by Lloyds says that they expect to see a 10% drop in the house prices this year. Right now we're at the beginning of the crash, so if you start looking for a house now, there is a chance you can find a great house that you may like, and it might be down 5%, and by the time you get the property, the house prices may have fallen a bit further. If that is the case, it could be an idea to get the property while it's still available, because it will work out in the long term as we go through the property cycle, as we seem to be going on a downward trend. From much of the data online, we can see that the dip has occurred in the property prices. So what does this mean for mortgages? Mortgages have started to come down, but not to the levels of sub 2%. At the moment, as things start to stabilize with inflation and the bank rate alongside lower demand on mortgages and competitiveness of the lenders, we can start to see a fixed rate mortgages of about 4%. Lots of this is driven by the bank rate, which is affected by inflation. And the table shows that the Bank of England thinks that the rate of inflation will drop down to 3% this time next year, and then 1% in 2025. It also shows that the bank rate may also increase. So this all shows that the mortgage highs have peaked and should now be lower than compared to a few months ago. And another factor to also think about is inflation. Now, inflation is the cause of many of these issues. High inflation means that the bank rate has to be higher, which will impact the mortgage rate. If inflation comes down, then so do the bank rates, and then so do the mortgages. If we take a step back, we can see when did inflation get out of control? And this started around the time of the pandemic, where we saw issues in the global supply chain. It means there were lots of demand, but the supply wasn't there, so goods and services started to rise. Then after this, with the conflict going on, it impacted our gas and electric prices. Energy prices are linked to inflation. The higher the energy bills, then the higher the inflation goes, With the cost of living, the cost of services are increasing, and people want pay rises, which is what we are currently seeing with the number of strikes that are going around the country. People want pay rises, but then you need to raise the cost of services, and this turns into a spiral effect. Cost of living is higher and people need more pay, which means the cost of services go higher, which then pushes inflation up, turning into a constant cycle. The longer it goes on for, the longer the Bank of England will keep their interest rates high, and that will ultimately affect our mortgages. The Bank of England thinks that inflation will drop as sharply as it rose, meaning we can hope to expect to enter 2024 with a more reasonable rate of inflation. It's not a given, as there could be other factors which affect this. What does this mean for a first-time buyer? It is difficult and has been for the last few years, as you would have been saving heavily only to see prices increase massively over the years. Understanding this will help you know how to position yourself going forward. Although you may not feel it now, things may start to look better throughout 2023 and 2024. Property prices will come down and the mortgage rates will come down too. It won't be as low as it's been historically in the past, but it will be better than it has been recently. That means you need to be ready to pounce when the time is right. It will be easier over the next year or so, but we will enter the recovery phase of the graph again, and that's the point when prices will start to get out of reach. So timing and being prepared will be important as a first-time buyer. But there are so many positives to take away as the economy starts to recover. Continue saving and keep track of house prices and rates. Understanding the 18-year property cycle and knowing it's based on 200 years worth of data, as we'll see the same thing play out again. Thank you for watching. You may like to check out my other video over here.